On today's Hot Sheet, I'm discussing the global sell off, Friday's job report, and opening numbers in the US, as well as housing inventory here for the week. Today is Monday, August 5th, 2024. I am Byron Lazine, and the Hot Sheet starts now. Welcome into this Hot Sheet, big Monday Hot Sheet, first Monday of August. We're all watching one thing across the globe. They're all watching one thing. What's going to happen with the U.S. stock market after Friday's jobs report? I'm going to get into the jobs report here in a minute. I'll talk about how that is going to impact our U.S. housing market, in particular, how it already has impacted the housing market, and how you should be articulating that information over to your database here this week. I am Don. I am doing great. Thank you, Don. I hope everybody's doing well. Just don't look at your stocks, okay? Just don't look at your personal portfolio, even though I have the Dow up here, down over 1,000 points, obviously here to open the market today. That's about 3%. NASDAQ's down, S&P's down, even the Bitcoin holders, they're even down. Could you believe it? Even Bitcoin. I thought Bitcoin was supposed to be the thing when chaos happens that goes up. Bitcoin was just, what was this? Just about a week ago, they were like $70,000. Now they're 50,000 for a Bitcoin. So Bitcoin was supposed to be like $1 million this year at some point. I don't know what happened to Bitcoin. Thank you, Kim. Kim on the 5 a.m. call this morning. Appreciate that. A lot of headlines going on, obviously. Biggest one started late last night when Japan's financial markets, the Nikkei, suffered the worst day since 1987, the Black Monday infamous day. And they're suffering their worst day hit by U.S. concerns. This is Wall Street Journal. Their stock average had the worst day since 1987, falling 12.4%. We're hoping that that does not repeat here. In a frenzy of selling triggered by disappointing economic data in the U.S. and a surge in the Japanese yen. Okay, so economic data disappointments. One of them would be this jobs report, which we're going to get into here in a little bit. The jobs report came out on Friday and has really triggered a lot of this, but it's not just the jobs report. It's also some real uncertainty of what's going on in the Middle East right now. There's a lot of uncertainty there. So those two things, economic data in the U.S., is the U.S. in a recession? We're going to cover that when I talk about the jobs report here in just a minute. You're going to hear the word recession a lot, especially after this Monday, August the 5th here. And then the uncertainty of what's going on in the Middle East has a lot of investors worried, and you're going to continue to probably see this sell-off throughout the morning. Now, what will happen later in the day? Is there going to be a snapback on the markets where people will say, hey, these prices are getting too low. We just don't know. We don't know what's happening in the middle. We don't know if we're going to have a recession. Are some of these investors going to come back in and be buyers later on this afternoon and push prices back up? Or we're going to cut into some of these losses? Or will the losses get worse throughout the day? Like we obviously saw with the Japan stock market. Really, we haven't lost, much else since opening here, since the futures. So down about 1,100 points on the Dow. And so we're just going to have to watch that. But there you go. Those are the big headlines all over the country. Now let's go into the jobs report because this is really spurring a lot of it. Jobs came in at 4.3% on unemployment. We talked about this on Knowledge Brokers Podcast. You can go over to @Knowledge Brokers Podcast for that full discussion. But it's really pointing towards this rapid increase, from like 3.5 now to 4.3. We've often said here, hey, this is something that the Fed likes to see. They want a softening in the job market. It's going to make their job easier. But now we're getting into an area that nobody expected. Now, this is a preliminary number, this jobs report. So this could get revised the other way, the other direction. It could get revised worse. That's what we've actually seen the last few months when these revisions come out. They typically go in one direction. they keep getting worse. Now it could get better. We don't know, right? This is the preliminary number. Whatever it is, a month or so, we'll see some type of a revision here. But unemployment is moving at a pretty rapid pace here from July 2022 at 3.45. Last time we hit 3.5 was July 2023. And then now just up to 4.3 from there. When you see this type of rapid increase, you're now going to hear a lot about recession, because you don't see historically an increase like this without it being followed by recession. And there is now a lot of people that are saying that is going to be the case. So we'll have to keep tracking that and see what goes on there. There's a deeper discussion, like I said, in Knowledge Brokers podcast around that. The ultimate number here on jobs, if I've got it, I thought I had it in front of me. Here we go. Rising the 0.2% to 4.3. And number of unemployed people increased by 352,000 to 7.2. That's the top line number. Where is the number? It's still in the it's still in the 200,000s. I'll find it. I had it. I thought I had it here. It's still in the 200,000s. Logan from Housing Wires is really got us pinned at like 330,000. Breaking that point is what he has been saying all year, as his model suggests, is when the Fed is going to bend, right? We talked about last week, the Fed did decide not to take the interest rate down. There's some talk today. I mean, I saw an article today where people are calling for the Fed to do an emergency rate cut. I can promise you that isn't going to happen. The last time it happened was 2020. Obviously, there was so much uncertainty. This is kind of a natural market situation, uncertainty in the Middle East. You've got a bad economic data from the U.S. You're going to have some sell-offs. Maybe some of these stocks were overvalued anyway. All of that could be argued, but you're not going to see 2-3 days after coming out and saying these are the reasons why we're not cutting the rate, Jerome Powell coming out with his tail between his legs this week and doing an emergency Fed rate cut. Even if you believed he should have cut the rate last week, he's not going to do that this week. I can promise you that, right? It would take some mega unforeseen event that nobody wants to see or nobody wants to even think about for him to come out there and do that. Okay. But ultimately, when we get up over 300,000, let me get this number, because it is a relevant number here for us to understand. When we get up over 300,000 on jobs, if we get there on job loss, that's when we expect the Fed to cut. Now, CME Group expects a 100% chance that they're going to do it in September, right? Those are the betting odds right now. 323,000. Okay, so that's the number. I believe jobless claims have to break over 323,000 on the 4-week moving average. Okay. Right now, the 4-week moving average on initial unemployment is at 238,000. So we're still 100,000 away where the Fed is going to be forced into a position. But it's inarguable that the 4-week moving average is doing nothing but moving up and to the right in terms of unemployment. Okay. After hearing about how great unemployment was, and the unemployment numbers are so strong, we've got the best unemployment numbers of all time. We're now seeing not only softening, we're seeing weakening in the job market. 4.3% has beat expectations. And it's starting to get serious right now. And it's not just like, oh, don't worry about it. When you see 12% Black Monday numbers from the Japanese financial markets, you start to really put an understanding around the fact that, okay, this jobs market is significant, because if the U.S. goes into a recession, remember, Q1 GDP, if you go traditional recession, it's like you got to have the 2 quarters of GDP declining. Q1 GDP was revised downward. Quarter two GDP just came out. It's a strong 2+% until the revision. Like I said, all year, all these revisions that have been coming out have been going one direction. They've been going, downward when they come out and get revised. So that remains to be seen. Now, losing jobs, we're not losing enough jobs where it's like, okay, it's clear, and we don't have these negative GDP prints that it's clear, but it does catch up with you quickly. And the Fed is 45 days now away from having another meeting. So did they make a mistake? That's gonna be a headline there. Did they make a mistake not cutting the rate last week? Okay. And the other thing here too, to keep in mind, to bear in mind on the job numbers that we have had this year, they are almost all of them are being driven by the government. Okay. So when you see this monthly change in employment by industry, you see government as a category. Well, that's not accurate. Okay. So a lot of these jobs, like look at construction. Okay. Construction is not all private construction. So you have construction that is like a government entity going out and then doing, some type of infrastructure deal. And then, construction has to, company has to go out, or a union has to go out and hire more people, but it's government dollars. Okay. There is a lot of government dollars supporting the job market. It's almost entirely been the growth this year on jobs has been almost entirely driven by the government. We're spending something like 6%, and our GDP is growing at 2%. Okay, so we're spending, our budget is like at 6%, and we're growing at 2%. So if we weren't spending all this money, we'd actually be at like -4% growth. So you can look at these numbers a lot of different ways, right? And that's where people were picking apart the jobs market until this, report on Friday. It's like a lot of these are part-time jobs. So you got a lot of different ways to look at this. Ultimately, there's some stuff hitting the fan here on this Monday. We will see, where that takes us. We'll see where it takes us. We know right now in the short term where it takes us. It takes us to a 52-year, that'd be crazy, a 52-week low on the 10-year. Okay, so the 10-year has plummeted 3.721. I mean, look at this year to date on the 10-year. If I can get that to, here we go. Year to date on the 10-year. Lowest point in 52 weeks, obviously, lowest point for the year. Just in June, we were up over 4.5. In the beginning of July, we were at 4.5. Now at 3.72 in the beginning of August here, 52-week low. So 10-year having a reaction right now. How about the 30-year? Look at this line on the 30-year fixed. Just on July the 25th, we were at 6.91, and we ended the week last week at 6.4 on the 30-year fixed. You could make the argument, just off of what we've seen, that we're going to be around 6.25, based on Friday's spread, right around 6.25 on the 30-year fixed. Okay, 30-year fixed is at its annual low this year. 10-year fixed at its annual low. 30-year fixed, obviously lowest since we've seen, when did we even get there? We haven't been there. Let's take a look. We haven't been here on the 30-year fixed. And this is something I'm urging agents and all agents of change, people who are in this industry, advising people to get information out. People are going to be looking at their stock market today, and they're going to be like, what the heck is going on? I should have sold Friday, as if they would have known. All these types of things. This information to get out for people who are interested in real estate, that there might be a moment in time We don't know if there's going to be a recession coming. We don't know if these rates, the 10-year and the 30-year, are going to snap back like we've seen multiple times in the last 2 years. We've seen snapbacks of 0.5% back up multiple times in the last couple of years. We don't know. We know we have a moment in time right now that if you're in the market, you could certainly take advantage of this particular opportunity. Okay, so in December we were at 6.6. We're going to be down like to 6.25 here later today. And the last time we were in that range, you got to go back to April of 2023. So Friday we met the low of December, and then today I could basically almost guarantee, without guaranteeing it, that we're going to hit our low point since early 2023. Okay, quarter one of 2023. Last time we hit 599 was February 2nd, 2023. Absolutely not calling that here today. Don't think that that's where we're at based off of where the 10-year is right now as we do this show, and where the spread came in on Friday. But 6.25 in our sights, first time since quarter one of 2023. I'd get that information out. I'd also get it out to sellers. If you've got a seller who's been on the fence, right now you might have a little burst, a little pop of buyer activity. One of two things is either going to happen. Either we're going to go into a recession and things are going to get worse, and in that period of time, you could argue that home prices are going to be impacted. Or number two, we're going to avoid recession. We're going to start talking about soft landing or manageable recession. And we're going to have an economy that really bounces back and is strong and all this stuff, right? That's the other thing that not many people today are going to be predicting that, obviously, here in the moment. But in that scenario, what happens? Rates go up, and you're probably dealing with a decrease in buyers. Right now, in this period of time, this period of chaos, right now, before you get too close to the seasonal decline of November, December, before you get too close to the election, before you get too close to all of these things, while your house is still looking beautiful because the weather's nice, right now might be your moment to list that property, to go ahead and sell it, to get that value close to whatever the record price is in your neighborhood or whatever, the recent comps suggest. Not predicting that prices are going to fall off a cliff or anything like that, but you might have more buyers. We might have a burst of buyers with where that 30-year is trending. We might have a burst of buyers where that 30-year fix is trending right now. And you might want to take advantage of that moment in time. Have lots of conversations all day. Be on the phone with your lender, bouncing off different scenarios. Hey, I've got 15 real buyers in my database right now. I've got 75 buyer leads. 12 of them are real. Whatever you've got that you're working with, here's where they were last time. They've kind of gone on pause. Here's their affordability issue. What's it look like today? You go from 6.91 just about a week ago down to what looks like 6.25 today. There's a lot of mathing that you should be doing to help the people that are in your database. Okay. So there you go. Jobs, driving jobs, and obviously huge uncertainty in the Middle East, America, potential recession, new wars or extension of wars breaking out, creating a sell-off globally. What it means for housing is 30-year fixed, lowest level all year, lowest level since quarter one of 2023. The 10-year lowest level hits the 52-week low, obviously the lowest level all year. So you get this chaos all of a sudden for those that can afford, those that are shopping, those that are financially strong. All of a sudden, real estate got a little bit cheaper. All right. So as we do every single week on Monday, let's get into inventory. This is how we kick off the hot sheet. We might have a few new hot sheet people. Let me know in the live chat today if you're new to the hot sheet. If you're tuning in live and this is your first time on the hot sheet, we do this show every single Monday through Thursday when the stock markets are open. And boy, they are open today, but just not a lot of people are loving what they're seeing out of the stock market. Let us know. Are you new? Subscribe to the channel. Hit the thumbs up. Consider sharing this stream with somebody who can benefit from it. BAMX members, you get all of the notes here from the hot sheet each and every single day, and all of these housing inventory. We have 7 charts inside of BAMX here today. Use code HOT to get inside of BAMX to get access to those charts. All right, let's take a look at the inventory update. Obviously, I talked about a little bit about the mortgage spread here. Here is the mortgage spread. It's about a half a point better than last year. So think about it this way: if this was 2023 and this was going on, we'd be talking about 6.75 just on the spread between the 10-year and the 30-year, and not 6.25. So the spread is improving. It's still not back to historical normal levels. The mortgage purchase application index, we continue to have less demand than we had at any point last year. Okay. And we continue to have less demand than we had in 2022. That's the reality of this market. Okay. Demand has been suppressed by an extended period of time of restrictive policy and unaffordability for the buyers. That's why when I talk to a seller who's sitting on the fence, either this trend is going to continue and it's going to be amplified by a deep recession and job loss, and you're going to continue to see the trend of the last 2.5 years get extended, where you don't have a lot of buyer demand and you're sitting on this property for a year, 2 years, and maybe even seeing value get kind of chipped or chiseled away. Or you take the moment in time that we're experiencing here on this Monday with everything going on to understand that there's going to be a little pop of intrigue, of affordability, of some buyers maybe entering back into the market, and you can take advantage of that. Okay. Going back to inventory, because inventory is ultimately going to help more of these buyers, obviously, as well as these rates. You're starting to see almost every day, coupling with inventory and the rates now, a little bit more of an affordable situation for buyers. This is Altos research that we look at every single week. We had a 6,000 plus increase in active inventory for the week. That brings us to 683,000. That's 40% more active inventory across the country than this point last year. We're still way off of what I consider a normal market of 2019, which we were at 965,000 at this point. So less, though, than 300,000. We've been able to say 300,000 spread for quite some time. That's a 280,000 spread. So that spread is starting to shrink as our inventory grows this year. Okay, this is the inventory peak for this year. It's the inventory peak for last year. It's the inventory peak for the last 4 years, this moment that we're at right now. We started 2020 at 763,000. So January 2020 was before COVID was a thing. Okay, that was, I know it probably was a thing. I think it started late 2019, but it was before it was a thing here in the US, before anybody was thinking about it, knew the name, talking about it, right? That didn't happen until March of 2020. We didn't flatten the curve or start working on that until March. We didn't shut down until March. So January 1st, 2020, we started the year at 763,000. My point is, if COVID never happened in 2020, we were going to have a low inventory year in 2020, no matter what. It obviously wasn't going to be what it was in the second half, but we started at 763,000. We're at 683,000. We're in striking distance of getting to early 2020 levels of inventory. And we'll see how much more inventory. We'll see how much, like today's news and what's going on here with everything that we've been hit with the last couple of months. We'll see how much that plays into people saying, I want to maybe get my house on the market. Okay, what's new listings going to look like? Are more people going to be interested right now in potentially getting out ahead of uncertainty? Everyone with a 401k, as they're looking at it today, they start to, not everybody, but there's a segment. The people that make money don't do anything with it. They ride this thing out. And then there's people that get antsy. They start making moves. Maybe they put a house on the market. Maybe they go and sell some stock today. They move some things around. They get a little antsy. They get a little uncertain. Okay, you might see some of those new listings coming onto the market. Last week, we had 67,000 new listings versus 60,000 in the same week last year. Last year was the all-time low on new listings. In 22, we had 73,000. Okay, so we're still not at 22 levels, but we're above last year's level of all-time low. Thank you. We're getting into now, we're just a few weeks away, a couple months, a month and a half away from that seasonal decline, that complete drop off of a cliff of new listings that we see every November and December. Okay, I'm arguing that November could happen in October on new listings outside of some of all this other stuff that was happening, but just based on election coming up, it's like, hey, are you really going to list your house 2 weeks before the election, or are you just going to kind of roll that, bump it into next spring? I really think when you're thinking about your sellers and the people that are on the fence, it's now or next spring. I honestly, if you've got the timeline, if you can do it, obviously there's going to be people that list in December because life is, I just got relocated. I got to move by the end of January. I got to, sell my house here in December, despite holiday, despite, a lack of buyer intrigue, whatever the case may be. Okay. But you are going to, have an opportunity as a seller who's got the timetable to either take advantage right now or go ahead and move into next spring market. Here's the price cut situation happening. 39% right now of properties with recent price reductions, 35% at this time last year, 38% in 22. 22 had higher than normal. Normal would be a third. 22 had higher than normal because we were just second half really absorbing those initial interest rate hikes. This year it's happening because inventory is up and buyer demand is way down off of 22 and 23 levels. So that's where we're seeing it now. And you see that demand reflected in pending sales. Pending sales coming in at 379,000 currently. That's 4 points more than this moment last year, where it was 364,000, 405,000 in 22. These are really low numbers on pending sales when you look historically, and obviously we have historic lows on or near historic lows in the floor of existing home sales at 4 million. So, okay, there you go. Let's just take another quick look before we jump into our Monday here at what's going on in the markets. Take a look at the 10-year. 10-year still just kind of hovering at its 52-week low of 3.717. If we take a look at Dow's, still just down 1,000 points. S&P's down 3.25, and NASDAQ's down 4 points. Okay, so as we enter into this Monday, that's what's going on. Agents should be having conversations with the people in their database, bringing them this information first. There's going to be a lot of headlines. I just told a bunch of agents here in the office, I said, do not send like a group email or a group text saying, hey, the rate's lower today. They're going to see all the headlines. Give them a call. What do you understand about what's happening and how this is going to impact your opportunity here to buy if they're a buyer, or obviously somebody who's thinking about selling? What's your experience been in these types of situations? Should you wait? Should you do it now? Should you wait until the spring? Have those conversations with them. Walk them through this data. All right. For agents of change that want to be on the forefront of everything that's going on in our world, join me and all the speakers at BAM Mania in Las Vegas, October 18th, Circa Las Vegas, October 17th for the VIP experience, October 17th and 18th, Las Vegas at bammania.com. Tickets are selling fast. We're going to be probably out of VIPs here pretty soon, and then we'll be down to the remaining general admission. Here is a look at your lineup. Circa Las Vegas, brand new venue. I know we did a poll the other day who people's favorite speakers in the industry was, and this guy right here, Sharon, came up a whole bunch. He's going to be sharing a lot at BAM Mania, but we have an extensive lineup of speakers, and really encourage you to check that out if you're interested. bammania.com. Get your tickets today. All right, there you go. There's your hot sheet for this week. Could be a wild week. Looking forward to being back with you all tomorrow morning to break it all down, see where this thing closes out at. Hopefully we get a snapback and we get a 30-year fix that maybe drops below 6.25. That's what I'm hoping for today. If you're watching the replay, let me know in the comments what you're hoping for. And until tomorrow, of course, toodaloo.